Hello and welcome back to another day of charting. My name is Justin and today we're going to talk about Jerome Powell, the FOMC, and what we can expect from tomorrow. I want to thank you for your patience over the last couple of days because life happens and things don't always happen on time or on schedule, but I'm now set up at my new place and I'm excited to jump in and get us ready for tomorrow. So again, Jerome Powell here has a little bit of a sourpuss on his face, and I think that's what we're going to be getting tomorrow. So is it going to be the mouth in the front of your face or the back of your back, which is going to be puckering? I don't know. I'm looking to what to watch for tomorrow, which is going to be the FOMC rate decision on May 4th. The top three things to watch for are going to be balance sheet runoff, size of the hike, and inflation language. So the reason why this is so important is because the narrative that has been crafted so far has created a few things, including the market doing a lot of the heavy lifting for the Fed. We know that their words have been the most powerful tool they've had lately. And as we look forward to, again, the size of the hike and inflation language, I'm going to try to speak to each one of these individually. And then we are going to look at some charts, and we will talk about the heat map, economic calendar, and everything else. But let's just focus on this first. Balance sheet runoff. As a reminder, we've talked extensively about this on the last couple of weekend deep dives, notably Bear Market 2.0, where we say that if the balance sheet runs off, the stock market pretty much tracks. Why? Because now there are alternatives. It's not TINA. So the balance sheet runoff is basically going to be acting as an additional rate hike. And how they communicate it is going to be really important. When do they start? What is going to trigger the start? What's going to trigger the stop? And what's going to trigger a reassessment? The size of the hike. Basically baked in at 50 basis points, there is a micro chance it could be 75. That would be a shock and awe. If that's what Jerome wants, that's what he's going to do. I think that is a pretty low probability. So the question is now, we've had that one hike out of the way at 25 basis points, and the market reacted very bullish. Now the question is the market going to digest what we've now heard if it comes in line? I don't know. Inflation language. We now saw the PCE coming in at, I think it was a 5.8, which is the Fed's favorite gauge of inflation. So the inflation language is going to really matter. It's also really important because we're going to be told how to interpret future data. I'm talking specifically about the Fed's dual mandate of full employment and price stability. So when we look here, we're going to be getting non-farm payroll on Friday, which is going to be the April jobs report. And then we're also going to be looking at the unemployment rate for America. Right now it is at 3.6, and it's expected to come down to 3.5. Remembering that anything below 5% is considered full employment. So with full employment checked off and a massive amount of job openings, which will be confirmed. Do we have jobs opening this week? No, we do not. So unemployment rate, again, one part of the mandate's been met, but we do not have price stability. Inflation is out of control. So the reason why that matters is because when we look here at the 10-year note or the TNX, it's now breached 3%. It got to 3.002, settling today at 2.95. Reason this matters is because when we look here at not a daily chart, not a weekly chart, but a monthly chart, we're noticing a pattern here. There was a clear channel where we did not breach above the 200 monthly moving average, or the 50 really pretty much, until now. And it's been a decisive break. We can note here that off the 2020 lows when we were at right 4, which means 0.4%, up here to 29, that's been a 700% rip. Incredible. And year to date, right, we're up 100%. And we got more room to go. This is just a breakout. So if this 30-year pattern is going to continue, how high can it go? Oof, I don't know, but it can definitely go a lot higher. And the reason why this 10-year note really matters is because it basically acts as the amount of money you are going to make that is going to be risk-free, your risk-free return. So if you got a risk-free return at 3% and you don't have to worry about stocks or anything, we're now seeing that TINA is getting a big chink in the armor. We showed you this this screenshot here. I think this was 2 weeks ago when we did the Bear Market 2.0, and this right here pretty much shows us the other thing I was trying to explain. This is from BlackRock, and again, this firm really matters. They are huge. We look here at U.S. high dividend stocks dividend yield versus U.S. investment grade 3-year yield. And we note here that the blue line, or the difference, is pretty much all the way down to 0, and it got unwound really fast because the orange line skyrocketed, right? From about 1% all the way up here to 4%. So that is not really all that great. And I'll show you a quick example here, then we will advance. So with this 10-year note over here, what I'm trying to show you is that when we compare this to, again, a made in America chip company, right? Trading at what? It's trading at 7.48 PE or 7 times price to earnings. Incredibly cheap. It's offering a 3% dividend, 3.25 dividend yield as well. However, there's a huge caveat here, because to make your 3.25%, you have to own the underlying stock. And year to date, oh baby, it's red. It's not as red as the other chips, but negative 12. So get paid 3.5, but lose 12.5. That doesn't seem all that great. It's red on the 1 week, 1 month, 3 months, 6 months, year to date, and 12 months, which means that 3.25% dividend yield is high compared to other stocks, and it is cheap, but it is not risk-free. So that is where this is now showing us that the TINA alternative is now starting to see some pressure. We can look at one other example here, which is going to be Paramount. Again, another company that I personally like. 3.17. So again, a little bit lower than Intel, but the PE is nearly half as well. It's at 4. You're paying 4 years of earnings for the current price. Again, noting that there was a very high blip in Q2 of 2021, but cannot deny that this is cheap. However, let's look and see if it's cheap enough. Right, now we look. Okay, green on the 1 week, but it is red 1 month, 3 months, 6 month, year to date, and 1 year. So what that means is that if you've held onto the stock for year to date, you've made about, right, your 3.17%, but you lost 1%, which means you're netting out about 2. And as we noted over here, just holding onto a boring 10-year treasury note, you made 100% year to date. Woof. So that is where, if we hear the language that, where's that screenshot I just shared? Let me just pull it back up here. Sorry if there's noise in the background too. Where is this one? Oh, I can't find it now. Oh, this one here. Sorry about that. This one here. So now we understand what's going to be important for the Fed. It is the balance sheet runoff, size of the hike, and then inflation language. So now we're going to focus on the size of the hike. This really is important because as we look forward to the meetings coming up here, there is going to be some data coming out, economic projections. So it's all but a guarantee we're going to be getting 50 in May. And then we're looking at how are we going to get the 200 basis points? Well, 50, 50, 50, 50. That gets us to 200 or 4 times 50. So 4 times 50 is 200 plus the 0.25 we did in March gets us to 225 basis points. We're talking about getting to 3% by the end of the year, and the TNX is pretty much confirming it by already being at 3. So what does that mean? Well, we've got 1, 2, 3, 4, 5, 6 meetings left. We'd have to go by basically 50% at every meeting except for one, and then 25 at one to get to 3%. So if we start hearing language or commentary that the current market is not baking in enough rate hikes, that is going to add pressure. I would also note here that right in May, there is no asterisk. In June, there is, which means if we do 50 in May and we do 50 in June, they're going to have to explain to us the reasons why they're doing that with what? Their summary of economic projections. And we're going to be getting a data point on Friday, which is going to be very important. We're going to be seeing that. We got JOLTS jobs openings today. So 11 million jobs open. That's a lot. It keeps increasing. So this we're at maximum employment. And inflation, like I noted, PCE is at a record high. Sorry, not a record high. I think it's like a multi-decade high. So this is going to really matter. What Jerome has to tell us is how to interpret the future data. So inflation language. What is he going to say about inflation? And by the way, he does not have the tools to actually impact inflation himself. So if his job's been met, he should be going more aggressive on the rate hikes. And the market has pretty much baked that in. So when we think about what we're going to hear tomorrow, it's going to really matter. So starting at 2 o'clock, we're going to be getting the interest rate decision, and then probably going to include a statement on balance sheet runoff, and then Q&A starts at 2:30. So that's going to really, really matter. Right? He's going to be scratching his head or holding a certain type of thing to his head. Maybe, maybe not. So again, come on, Jerome, pucker up, right? Puckering up in the front or in the back, I don't know. There we go. All right, so there we go. We've talked about the Fed, what it could mean, and now what I want to go through next year. So great, right? So the reason why this really matters too is because we're seeing that there is waiting for S&P to capitulate. Again, this is from Bloomberg. We can note here that just looking back in time here to 2018 and 2020, which were the drops, we can note that we had to dip below the red line here. The red line is going to be signifying 30% of the S&P 500 companies being above their 200 DMA. So as of right now, we're sitting here at about 35%. For us to truly capitulate and then go back up higher, we had to dip down to roughly about 15% here in 2018. And then in 2020, we went down to about 10%. So as of right now, we're sitting here at 35.72, which means that 35% of the S&P 500 companies are currently above that 200 DMA, or that's about 178 companies. This is really important too because earnings season is pretty much winding down, and we saw that more than 3/4 of the S&P 500 companies either delivered what was expected or beat. So if beating does not drag them up and they're below their 200 DMA, it means they're pointing down. Good news doesn't make them go up. So if good news does not make you go up, what can bad news do? Oh crap, right? Yeah, it can make you go down. Now let's look at our base case just to see whether or not anything has changed. TINA for stocks, right? Put an X through that one. 454 pivot. Yep, it was a bear pivot. Bulls and bears fight for direction. Bear edge. Absolutely, still a bear edge. Earnings confirms the move. April 19 to 28. Okay, cool. So now let's look at some charts. Before that, let's look at the heat map actually. So let's go to the heat map here and just try to understand what happened today. But since I am coming back to the screen after being away for about 2 days, I actually prefer to zoom out and see what happened in the last 1 week. Ah, there's my friend, Mr. Red. Hello. Nice to see our sponsors back today. What do we got that's been moving in the last 5 days, or basically being accumulated up into the FOMC meeting? Well, not a whole lot. Facebook, Qualcomm, Microsoft, Visa, MasterCard, and Energy. Home Depot and Lowe's. This does not seem super fantastic to moi. If we look back here at the last 1 month, oh, even worse. Nice. Look back at the last, let's look back at like year to date now, sorry. Let's go back to year to date. Oh, Red, my old friend, it's so nice to see you. What do we have? We have healthcare, we've got energy, we got defensives, and utilities, right? The Mike Wilson playbook is in play. So this is not terribly nice, and it's pretty obvious by looking here and a zoomed out perspective that the market is currently got some troubles ahead of it, has some headwinds. So now what I want to do is look at a few charts. So we can look here at our quarterly chart first, and that'll be the highest time frame we're looking at. You can't look at this and tell me it's bullish. And the risk here is that we looked at that data from 2018 and 2020, and the reason why it's important is because of that stocks below the 200 DMA. We've been dripping, not dropping. So the fact that we still have too many names above the 200 DMA means that Jerome has room to crank us lower, get inflation under control, and then actually dial back some of that rhetoric. So this is not a 1 quarter contraction before expanding. We clearly broke the, yes, we're not going to 569 yet. I think eventually we will. Might be 2023, might be 2030. I don't know. I think we're going to get there though. But anyways, we're going to rally into the beginning of the next quarter. That's invalidated. So now what we have to look at is periods where there were multiple big red quarters. When was that? 2008 and 2000. Oh no, that does not look nice. No, it does not look nice. It means that we're potentially in for a much bumpier road. So the quarterly chart, if we fall back below, and we already did, by the way, fall back below 410, it's pretty much lights out. Why? Head, shoulder, shoulder. That's a head and shoulders pattern. Let's zoom in now to the monthly. So looking here on the monthly, what we note is that, oh yes, my old friend. So high, lower high, lower high, low, lower low, lower slow. And right now we are hugging the low that we set back in March. All this dip buying is red. We got a massive push and we have a head and shoulders, which is why we have a red line here. 2 months above and everything else rejected. We're now below the green line, which is that quarterly base. And that 384 area seems like it's going to be a magnet. So the monthly chart here does not look super fantastic. Looking at the weekly chart, There we go. There's our volume breakout, right? So as we push down to the low, volume breaks out. It confirms it. We're still trending down technically. Where do we have to get to break it? We got to get up here to roughly 421, 422. And 422 is already very important from the relative low, from the Fibonacci extension. And there you go. Finally, looking at the daily charts, what do we have here? Let's zoom out a little bit further. There is our all-time high in 2020. There's the all-time high connect. And what do we have here? Oh, we got a dead cat bounce and then a rejection at our previous very strong support area. We pushed down to the 261 extension and then dead cat bounce back up to settle just below, or just above, sorry, these relative lows. Not terribly bullish to me. Volume is okay. Need confirmation though. Finally, let's look at the hourly chart for the shortest time frame. And here we can note that technically we hit the 50 MA, we rejected, and right now we're rocking that VWAP, and we are still in our funnel lower. We've been breaching below though 1, 2, 3 times. And when we look here to what happened yesterday, I think that a lot of people are like, oh my God, the big one's finally here. Why? Because when we got a big one, again, people are remembering the moves that happened like back to here. Mega booms, just like we had back here, mega booms. And your recency bias is going to train your brain to think that it's the same as last time. I don't know that it is. This for me has the textbook characteristics of a bear-fueled rally. Why? Hit 405.02 and then it is a race to cover by the close, because if they've been shorting this, right, 460s, 450s down to 405, oh man, that's a beautiful trade. And I think that they're strategically positioning to reload. There are no calls. The calls are MIA. There are puts, and puts. So if they can manage to jack it up, hold it flat, those puts are going to get smoked if they're eventually going to go in the money. Kind of like what happened here. Kind of like what happened here. And kind of like what happened here. Right? Sideways down. Bounce down, 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 down. So this big volume right here is very interesting. And like I mentioned, the net effect from Jerome speaking tomorrow is going to give us a decision one way or the other. The Bears have a lot of work to do. A lot. We got to get back above 432, which would what? Get us out of correction territory. So let's actually look at QQQ, then I'll go back and wrap up the story here, because I'm already realizing the video is probably at about 15 minutes here. I don't want it to be too long, but informative. Got to talk about DXY too. I forgot about that. So let's now look at the monthly chart here. Yes, we're so green. We're up by 1.7%. The intraday volatility is absolutely starting to get some people really whipsawed. Previous lows are 317.45, 318.26. We're basically hugging the previous monthly lows, which were what? Massive dip buying areas, because there's these big wicks. Right, there's potential here, but no, I'm not impressed. I'm not impressed. Looking at the weekly, we're right on the green line, right on it. We got to get above 320 minimum. Otherwise, that is a big flush in red volume, a dead cat bounce before resuming lower. On the daily charts, right, we're clearly in a megaphone here, and I don't know. I got to update my lines here. We are below the previous big level, though, right? So that's not great. There's that big booms everyone's kind of expecting. This was an incredible pump. I remember it, right? 7% intraday. Whoa. So as we wrap this up, one more culprit here is going to be the dollar. And the reason why the dollar is important is because, again, TNX and DXY were our two culprits for the bear market of 2022. And as we look here, we're now completing a W where we have huge upside targets of 106 and 120. And what's really important, I mentioned this on our pre-market private live stream this morning, is that we've already broken through the previous tops here, which means that we've price discovered and taken out the previous tops to complete that W. We back tested intraday to our previous high set in 2020, and we held. So if we start to advance from here, this is a classic breakout above 100. Where we go? 110, sorry, 105, 110 and higher. Also, the Bank of Canada has already increased interest rates by 0.5. And the Canadian dollar rallied about 1% against the US dollar. So I would expect roughly the same if the Fed follows suit and also raises by 50. So if we go up by roughly 1.3%, where does that get us to? Oh no, don't tell me that. Yep, we're pretty close to 105. So that could be all it takes. TNX gets back above 3%, DXY gets to 105, and that could spell disaster. Why? Let's look at the chart from when I started the bear market of 2022. So Negative 10% off the S&P highs at about 480 is about 432. So from where we are right now, we have to rally an additional 4% for us just to what? Get out of correction territory. And then we got to go up by 7% to get to the 50 DMA. And then to break bullish, we have to get to 454. We got to rally up 9%. And no one is buying calls. Everyone is buying puts. So again, sell in May and go away is what it seems like. We got to rally massively before we're going to get any kind of bull market. QQQ. Negative 20 is going to be the blue line here. So again, we got to rally up by about 3% to get out of bear market territory. We got to rally up by 14% to get to the 50 MA. And we got to get up here to about 20% for us to invalidate that head and shoulders neckline here at about 383. So the reason why this is so important is because the base case is now showing us that we get a bearish confirmation post earnings. And again, looking back at the heat map, we cannot ignore what's been happening here. So for the last 1 week, but let's zoom out to the last 1 month, post earnings, again, the biggest dominoes or the biggest blocks now falling and being the reddest, right? Amazon, Google, Apple, Adobe, Oracle, NVDA, Tesla, yucky. This is showing us that the trillion-dollar companies are now joining the pack and they're starting to fall. So I wish I could do a longer video, but it's already getting long here, so I'm going to leave it there. I wish you all the best of luck for trading through the FOMC tomorrow. And just remember, there's always another day. There's always another trade. Every trader gets another chance. It's called tomorrow. So if tomorrow's not the day for you, or if you're not sure what to do, don't do anything. Sit on the sidelines, wait for the confirmation, buy a little bit higher. Good luck.